If you lost money last week, it wasn't the chart. It was your operating system. Today we upgrade it. Not your broker, not your indicators, not the news feed. You, your rules, your reactions, your risk. Because trading isn't a test of who can predict the future. It's a test of who can execute a plan when the future refuses to cooperate. If you've been paying tuition to the market, this is the class where the refunds begin. Here's the truth most traders learn too late. Success in the markets is built in this order. Mindset, then math, then method. Mindset is the governor on your decisions. Math is the engine that drives expectancy and risk. Method is the steering wheel, the way you navigate different conditions. Get the order wrong, and you swerve even with a great strategy. Get the order right, and you can be calm, small, and consistent, long enough for edge to show up. In the next hour, we'll install 7 mental upgrades, the kind you can actually use today. Each upgrade comes with a simple rule you can follow under pressure, a tool you can apply when your pulse spikes, and a micro-ritual that takes less than a minute. No theory for theory's sake, no guru stories, just field-tested behaviors that lower your error rate and raise your durability. First, we'll cap the damage with risk ceilings and a personal kill switch, clear lines that protect your account from your amygdala. Then we'll shift your lens from single trade obsession to probabilistic thinking, so you judge yourself by the series, not the last outcome. We'll build a daily playbook that turns hope into if-then decisions. We'll add an emotional regulation toolkit that keeps your hands steady when your brain wants to sprint. We'll define your edge like a scientist, so you know exactly what proves you wrong. We'll size positions with simple expectancy math that feels almost boring, because boring is bankable. And we'll lock it all in with resilience systems, review, recovery, and accountability so you bounce, not break. By the end of this session, before you risk another dollar, you'll have a pre-commitment plan you can actually follow. Your loss limits written down, your circuit breaker in place, your edge card on your desk, your execution checklist ready, your anti-tilt routine within reach, your default sizing set, and your weekly review on the calendar. This isn't motivation, it's configuration. We're going to configure you to trade like someone who deserves to keep their profits. Take a breath. Sit a little taller. Imagine the version of you who doesn't chase, doesn't freeze, and doesn't flinch when a candle prints against you, because that version is built, not found. Let's begin the upgrade. Every trader loves the upside of the game. Few respect the downside. But here's the blunt truth: if you don't control your downside, the market will do it for you. And the market always charges more. That's why your first mental upgrade is this: installing a risk ceiling and a kill switch that cuts you off when emotions try to take over. Let's start with the daily risk ceiling. Think of it as the maximum you're willing to lose in a single session, your daily tuition fee to the market. Once you've hit it, class is dismissed. You don't keep pressing buttons hoping to get it back. You stop. A professional doesn't keep working once their tools are broken. A trader doesn't keep trading once their psychology is compromised. The cleanest way to calculate your ceiling is in risk units, R. 1 R is the amount you typically risk on a single trade. For some, it's $200. For others, it's $2,000. Whatever your R is, your daily ceiling should usually fall between 1 and 2 R. For example, if you risk $500 per trade, your daily cap might be $1,000. That's it. Hit that level, and you're done for the day. No exceptions. The size of the number doesn't matter. The integrity of the rule does. Now layer in a second guardrail, the loss streak breaker. Even with a strong edge, losses will cluster. That's variance. It's built into the math of trading. But here's the danger. Once you're 2 or 3 trades into a losing streak, frustration builds. Your next trade is no longer just about the market. It's about proving something, fixing something, getting something back. That's not trading. That's gambling. The solution is simple. Set a maximum number of consecutive losses you'll tolerate before forcing a break. 3 is common. 2 is conservative. 4 is aggressive. Pick your number and honor it. And when the streak breaker triggers, don't just sit there fuming. Step away for 20 minutes, set a timer, close your screens, stand up, walk outside, get some light, drink some water, let your nervous system cool down. This is not wasted time, it's recovery time. When the timer ends, you're allowed to reassess. If the setups are clean and your mind is steady, you can continue. If not, you shut it down. Either way, you've avoided the revenge trade that wrecks accounts. 2 more rules harden this framework. First, no new trades after hitting your max daily loss. Period. Once the ceiling is reached, you do not re-enter. Not on a smaller size, not on a perfect setup. You stop. Second, no averaging down. Ever. Adding size to a losing position is not risk management. It's denial. A stop loss exists for a reason. Respect it. If price moves against you, you're out. You don't dig deeper, hoping to be proven right. Now let's talk about your pre-market permission slip. Most traders give themselves permission to trade by default. Professionals make themselves earn it. Build a short checklist that you must clear before risking $1. Keep it simple. Did you sleep enough? Did you eat? Do you know today's economic events? Have you mapped key levels? Are you emotionally neutral after yesterday's session? If you can't tick every box, you're not cleared to trade. You can watch, you can journal, but you don't risk. Discipline here is what separates professionals from hobbyists. The second part of your permission slip is market conditional. Trading only makes sense if the market is in a state your playbook recognizes. If your setups require trend structure, but today is a tight range, you sit out. If your strategy thrives on volatility, but the market is flat, you wait. Your goal is to eliminate improvisation. You're not paid to be active, you're paid to execute edge when your conditions appear. Now the micro ritual that ties this all together. Before the session begins, take a sticky note and write, daily loss cap equal X, max consecutive losses equal Y, break equals 20 minutes. Stick it on your monitor, make it visible, then simplify your environment. Close the PL window. It tempts you to trade money, not process. Close the social feeds, they push you into comparison mode. Close the scanner that dings like a slot machine. Keep only what supports execution, your charts, your levels, your order ticket preloaded with default stop and target, and your journal. And expect resistance. The temptation to break these rules will hit the moment you don't want to hear them. The moment you're down 2 trades and the setup of the day appears, or the moment a candle rips without you and you're desperate to catch up. That's when you say the words out loud, I can lose today. I cannot lose discipline. Then you physically disrupt the urge. Stand up, push back from the desk, reset. Small physical acts can block large psychological mistakes. Understand this clearly. Risk ceilings and kill switches don't limit your potential. They protect it. They give you the ability to show up tomorrow with capital intact and confidence preserved. Without them, you're just another gambler hoping the next spin pays. With them, you're a professional who survives long enough for skill to matter. So set your ceiling, define your streak breaker, lock in your pledges, write the sticky note, and treat these as non-negotiable. Because once you remove hope trades, you remove the single biggest leak in your game. And that's when real progress begins. Probabilistic thinking and sample size discipline. Trading is not about being right on every trade. It's about executing a repeatable process that produces an edge over a sequence. If you still evaluate performance by the last trade, you're using the wrong lens. This section flips that lens from single trade obsession to series thinking and gives you the discipline to trust the math long enough for it to work. Start with the core idea. Outcomes in markets are probabilistic. Even a strategy with a positive edge will lose for stretches. That is not failure, that is variance. Your job is to manage exposure to variance and to measure performance across a meaningful sample size. A meaningful sample size is not 3, it is not 7. It is typically in the range of 30 to 100 trades, depending on your edge and the noise in the market. Decide on a sample size for your system and commit to judging your performance against that window. Think in terms of sequences and expectancy. Expectancy is the simple math that tells you whether a strategy is profitable over time. Put plainly, expectancy equals win percentage multiplied by average win, minus loss percentage multiplied by average loss. If that number is positive, Your edge works across the long run, but it will not deliver profits every day. It will deliver profits across the sample. That's why you must learn to tolerate clusters of losses without abandoning the system. Tagging trades gives you clarity. Create 3 tags for entries, A, B, and C. A trades are textbook setups that match your edge perfectly. B trades are acceptable, but not ideal. C trades are marginal, setups you would avoid if you were selective. Track performance by tag. Over time, you should see higher expectancy on A trades, middling results on B trades, and negative expectancy on C trades. If your B and C trades start to perform like A trades, you might be lucky. If your A trades suddenly perform like C trades, something changed and you need to investigate. Sequence risk is the psychological variable that kills accounts. A cluster of losses does not mean your edge disappeared. It means random orderings happen to go against you. The way to neutralize sequence risk is twofold: position sizing and humility. Size each trade so a losing streak of reasonable length does not bust your account or force behavior changes. That means risking small enough that you can survive variance. Humility comes from accepting that the market will hand you losing sequences, and the correct reaction is process adherence, not escalation. Make a pre-trade checklist that forces probability thinking. Before every entry, ask yourself, what is the probability this setup matches my historical A trades? If your answer is less than the threshold you set, don't take it. Give probability a voice in the room. Quantify it where possible. If A trades historically win at a rate close to 50% with a favorable payoff, and the current setup checks all the boxes, you take it. If it only hits half the boxes, it's a pass. This habit converts gut calls into probabilistic filters. Stop obsessing about missing moves. Missing trades are part of the edge. You do not get paid for being right about what happened. You get paid for how you sized and executed the trades you did take. Log the trades you passed on and note whether they met your criteria. If you repeatedly see profitable moves you skipped that would have fit your A criteria, reevaluate your scanning process. Otherwise, let them go. The market offers infinite opportunities. Scarcity is not the problem. Statistical thinking also improves your review process. When you audit performance, avoid headlines like "I lost 3 days in a row." Instead, look at the distribution. Win percentage, average win, average loss, R multiple distribution. Measure the frequency of A, B, and C trades and the expectancy by tag. Use charts across your chosen sample size, 30 to 100 trades, to see whether changes are noise or signal. If you change a parameter, do it in isolation and over a fresh block of trades so you can ascribe causality. Next, establish a rule. Only change one variable at a time. If you tweak your entry criteria and your sizing on the same day, you won't know which change caused the result. Science matters here. Make hypothesis statements like a researcher. If I widen my stop by 20%, then my win rate will fall, but average win will increase. Run that test for a pre-selected block of trades and record the outcome. If the hypothesis fails, revert. If it holds, document it and incorporate it formally. Micro-rituals anchor probabilistic behavior during stress. Before each session, read a 2-sentence reminder. I trade a series, not a single trade. My goal is to execute A setups with the correct size and discipline. Say it aloud. At each loss, instead of blaming the market, check the tag and mark the trade. Keep a visible tally of sequence length, 1, 2, 3 losses, so the streak breaker we set earlier can engage before frustration compounds. Finally, accept that sample size discipline is boring by design. It requires patience, restraint, and trust in numbers that don't resolve on demand. But that boredom is your edge. Most human behavior in markets favors narrative. They chase stories and dramatics. You will choose steady repetition. Over the long run, that wins. To make this practical, commit to 3 immediate actions. First, set your evaluation window. Choose 30, 50, or 100 trades and write it down. Second, implement the A-B-C tagging system and start logging tags now. Third, make a rule that you will not change more than one variable in your approach without running a defined test block. Do these three things, and your trading decisions will shift from emotional reactivity to statistical clarity. Probabilistic thinking gives you armor against randomness. Sample size discipline gives you the patience to let armor work. Combined, they stop you being a judge of single events and make you a steward of an expectant process. That shift is quiet, but it is decisive. It separates short-term gamblers from long-term professionals. Process greater than outcome. The daily playbook. Prediction is seductive. Preparation wins. If you want consistent results, stop trying to guess the market and start rehearsing your responses to what the market actually does. The daily playbook is the bridge between your edge and your behavior under pressure. It turns judgment, calls into checklists, and impulses into if-then procedures. Start with a compact pre-market routine. Keep it concrete and repeatable. First, map the key levels you will respect today. Higher time frame structure, support and resistance, pivot areas, and major moving averages if they matter to your method. Second, identify the scenarios you will trade. Trend continuation, range rejection, failed breakout, opening drive. Use plain language, no poetry. For each scenario, write the if-then rule. For example, if the market opens above yesterday's high and price holds above the 20 EMA, then favor long continuation setups with 1R risk. Or, if price opens inside the prior range and fails to reclaim the midpoint within 15 minutes, then avoid breakout plays. These predefined scenarios remove improvisation and keep you aligned with the conditions your edge expects. Your pre-market routine should take 15 minutes or less. The goal is not to master prediction. The goal is to be ready. Know where you will act, where you will take a scalp, where you will ignore noise. If you can't articulate your plan in 3 clear bullets, you are not ready to risk capital. Next, adopt a strict execution checklist for every entry. Make it short and drillable. Signal, confirm, size, place stop and target, and execute. Signal is your setup, what the chart shows that matches your edge. Confirm is the secondary condition, a volume spike, a structure level, a correlated market behavior that validates the signal. Size is pre-calculated in risk units, never eyeball it. Place stop and target before entry. If your platform supports bracket orders, use them. If it does not, enter stop and target immediately after filling. Then execute. No exceptions. This checklist enforces a simple truth. Good trades are repeatable trades. The market will reward the repeatable over the random. When you stick to signal, confirm, size, stop, and target, you remove the temptation to chase or to move stops on the fly. That does not guarantee every trade will win, but it guarantees that your process will be defensible on review, which leads us to a core metric that should guide your mindset: green by process. Stop measuring success by account balance swings and start measuring success by rule adherence. A green by process trade is one where you followed your checklist and respected your edge, regardless of outcome. A red by process trade is one where you deviated, late entries, moved stops, added size, or traded outside your mapped scenarios. Over time, green by process percentages are far more predictive of future performance than short-term profit and loss. Make green by process visible. In your journal, add a single column labeled process and mark each trade as green or red. Track the percentage of green trades over your chosen sample size. If your green rate drops, fix process before chasing performance. Post-trade tagging complements this. After every trade, tag it with quick shorthand: late entry, early entry, rule break, FOMO, tilt, good execution, or pure setup. The tags should be raw and honest. If you entered late because you hesitated, mark late entry. If you moved the stop because you panicked, mark rule break. These tags turn emotions into data. When you review, you'll stop blaming the market and start fixing behavior. Use tagging to spot patterns. If you see many late entry tags, your pre-market mapping or your scanning cadence needs tightening. If FOMO appears regularly, address your risk sizing and the permission slips we set earlier. If tilt shows up after a losing streak, Reinforce the streak breaker and the 20-minute reset. The point is not to feel shame. The point is to iterate. Data tells you what to change. Narrative tells you how to suffer. Embed short micro-rituals into the playbook that stabilize you before the bell. One high-leverage ritual is the 60-second trader identity statement. Before the session starts, read aloud a crisp statement in one sentence. Who you are as a trader and what you will do today. Example, I am a trader who trades 1R risk setups matching my A criteria. I execute only within my mapped scenarios. I stop when my daily ceiling hits. And I review honestly. Keep it to 60 seconds. Say it like you mean it. This aligns your behavior with your values and primes your nervous system for discipline. Another micro-ritual is the pre-entry breath. Take 3 measured breaths before placing an order. On the exhale, confirm your stop is in place. This short pause prevents reflexive entries and allows your frontal cortex to re-engage. Design your workspace to support the playbook. Keep one monitor dedicated to context, levels, news, calendar. Keep a second monitor for active execution only. Hide unnecessary tickers and floating PL. Open your journal window with a quick template ready to capture tags and notes immediately. The less friction between decision and documentation, the more honest your review will be. Build a default fallback for ambiguity. Markets will surprise you, and sometimes none of your mapped scenarios fit. In those moments, revert to a single rule. Stand aside until the market demonstrates a clear state. Indecision is not an error here. Premature action is. Waiting is a trade, too. Finally, practice the playbook like a muscle memory routine. Run simulated sessions where you go through the full pre-market mapping, run the checklist and tag trades in a demo environment. The aim is to make the checklist automatic, so that under pressure, you default to process instead of narrative. Process over outcome does not remove responsibility for performance. It reframes it. You will still be accountable for expectancy, sizing, and edge, but you will stop reacting to outcomes and start optimizing inputs, the only things you can control. When you execute the playbook and measure process, the outcomes follow with higher probability. That is the quiet math of professionals. Emotional Regulation Toolkit, Anti-Tilt Protocol. Trading isn't just analysis, it's applied physiology. When arousal spikes, reasoning narrows and habits drive behavior. The goal of an anti-tilt protocol is simple. Reduce physiological intensity fast enough that your frontal cortex can make the next decision. Here are compact field-ready techniques you can use the moment your body starts to outrun your plan. Start with the physiological reset. Use 2 deliberate physiological sighs. Inhale through the nose for a steady count, then take a second, slightly larger inhale and exhale fully through the mouth. Repeat this sequence 2 times. The physiological sigh reliably downregulates sympathetic activation and drops heart rate a notch. It's not breathwork theater, it's a quick neural break. After the 2 sighs, pause and re-evaluate the market state and your intention. If you still feel hot, repeat the sequence. Pair that with the 90-second rule for affect surges. When a wave of anger, panic, or excitement hits, do nothing for 90 seconds except breathe. 90 seconds is long enough for the peak of the effective surge to pass. In practice, stop scanning, mute sound, close entry windows, and watch a neutral object off-screen. Use a timer if you must. The impulse to fix the feeling usually resolves in that window. If it doesn't, escalate to more structured recovery. Step outside, hydrate, and extend the break. Use urge surfing for revenge impulses. Picture the urge as a physical wave that rises, peaks, and falls. You do not have to ride it. Name the urge out loud. This is the revenge urge. Observing it reduces its pull. When you surf the urge, you neither act nor suppress. You let the sensation exist and pass. A useful script. I notice the urge to trade to get back what I lost. I will let this pass and reassess after 90 seconds. Say it, then enforce the break. Labeling emotions is another high-leverage tactic. Cognitive science shows that naming an emotion blunts its intensity. Don't be vague. Call it what it is. Say aloud, I am angry, or I am anxious, or I feel shame about that stop. The language shifts the brain from limbic reactivity toward prefrontal processing. Do this before you make any trade decision after a loss. Labeling is not confession, it's a tool. Build a tilt triggers map, an inventory of personal vulnerabilities that reliably precede poor decisions. Typical triggers include sleep debt, excessive caffeine, recent social media exposure, and watching live PL. Track your own pattern. If you notice performance dips after less than 6 hours of sleep, that goes on the map. If scrolling Twitter before the open increases impulsive entries, that's on the map too. Once you have the map, proactively remove or mitigate triggers before the session begins. Technical controls support physiology. Hide floating PL on your platform. Money in green or red is an emotional accelerant. Replace dollar values with R multiples and a simple risk bar. The R multiple abstracts monetary noise into process units and keeps focus on odds and size. A visible risk bar that fills toward your daily ceiling provides clear feedback without the emotional sting of currency. If your platform can't natively do this, maintain a small overlay or a single-cell spreadsheet that shows current position size in 1R units and cumulative risk for the day. Create a concise anti-tilt checklist to execute the moment you notice escalation. Keep it to 4 steps and practice it until it is reflexive. 1. Close entry windows. 2. Physiological size. 3. Set a 90-second timer. 4. Name the emotion aloud and write a single-word tag into your journal. Anger, frustration, FOMO, tired. The act of writing transforms feeling into data. When you return, you have both a cooler state and an entry in your journal to analyze later. Design environmental hacks to reduce tilt risk. Keep water on the desk. Keep natural light or a lamp you can switch on. Remove social feeds from your primary workspace. Use a physical timer rather than relying on digital notifications. The tactile action of flipping a timer helps dislodge automatic behavior. Use headphones only for market-relevant audio. Random podcasts or music that spikes arousal are a liability. Anticipate the high-risk moments and pre-script your response. Example scripts you should memorize. After a stop. I took 1 hour and followed the plan. I will do 2 physiological size and check my process column. After a missed move. Missing a move is not a loss. I risked what I planned. I will review the setup in the journal and proceed only if an A setup appears. After a streak of losses, streak breaker engaged. 20-minute break starts now. Train these responses in demo sessions. Simulate a stop and then run the anti-tilt checklist. The more automatic the sequence becomes, the less the limbic system can hijack it. Finally, tie the toolkit to measurement. Track the frequency of anti-tilt events and their resolution. In your journal, mark each incident with the trigger, the tactic used, and the outcome. Over time, you'll see which tactics work and which triggers are most dangerous. Adjust your pre-market permission slip accordingly. If caffeine is a recurrent trigger, remove it before sessions. If sleep is the dominant factor, make sleep non-negotiable. The objective here is not emotional purity, it is the stabilization of your decision-making environment, so that rules, not reflexes, determine your behavior. Control the body and the brain follows. Use the physiological size, the 90-second rule, urge surfing, labeling, and practical environmental controls. Hide PL, show R multiples, and keep a risk bar visible. Do these consistently, and you'll stop losing to your own chemistry. Edge clarity hypothesis testing. Most traders don't fail because they lack intelligence or effort. They fail because their edge is foggy. If you can't describe your edge in a single falsifiable statement, you don't have one. You have a hunch. The path to consistent profitability requires scientific clarity. One trade, one edge, one hypothesis at a time. Start by writing your edge exactly like a science hypothesis. That means a clear market condition, a precise signal, and a defined action plan. For example, if the market is trending upward and price retraces to the 20-period moving average with volume tapering, then I will enter long at the first bullish engulfing candle, set my stop 1 average true range below the entry, and target a move equal to 2 times my risk. That's not vague intuition, it's a structured if-then hypothesis. The clarity forces discipline. Either those conditions exist or they don't. Next, lead with invalidation. Most traders think only about confirmation. They ask, what tells me I'm right? A scientist asks the opposite. What proves me wrong? Before every trade, define the invalidation trigger. Maybe it's a break of yesterday's low, maybe it's a close outside your setup zone, or maybe it's a volatility spike beyond your parameters. By writing the wrong condition first, you build objectivity into the trade. This turns the stop from a punishment into the fulfillment of your experiment design. Guard yourself against strategy drift, the slow, unconscious tweaking of rules that erodes edge clarity. Many traders change 3 or 4 things at once, then wonder why performance is random. Isolate variables. If you want to adjust your stop distance, change only that for 30 trades while keeping everything else constant. If you want to test entries at the 1-minute confirmation instead of the 5-minute, isolate that one change. 30 trades is the minimum block to evaluate a variable with any reliability. Less than that, and you're just reacting to noise. Remember, forward testing beats back testing when behavior is the true challenge. Back tests are sterile. They don't capture hesitation, fear, or tilt. Forward testing in live or demo conditions exposes your edge to the real frictions of execution. Clicking late, doubting signals, hesitating after a loss. A setup that shines in historical data may crumble under the pressure of live uncertainty. Forward testing reveals whether you can actually execute your edge, not just whether it would have worked on paper. To solidify this, build an edge card. This is a physical or digital card that sits on your desk during trading hours. On the front, your hypothesis written in 1 sentence, your entry trigger, stop, and target. On the back, 2 images, one of an ideal setup and one of a non-ideal that looks tempting but does not qualify. The edge card makes your edge visible, externalized, and immune to rationalization in the heat of the moment. If today's setup doesn't match the edge card, it's not your trade. When you consider adjusting your edge, treat it like scientific iteration, not improvisation. Frame your experiment before trading begins. Write, hypothesis test. Adjust stop distance from 1 average true range to 1.5 average true range for 30 trades. Success condition, higher win rate without decreasing average R multiple. Now every trade in that block is part of the test. The outcome isn't win or loss, it's data. At the end of the block, you analyze results and decide if the adjustment strengthens or weakens the edge. The danger comes when traders alter their strategy mid-block. They hit 5 losses in a row, panic, and change the rules after trade 6. That's like a scientist abandoning the experiment halfway through. Of course, the results won't be valid. Consistency of testing is what separates the pro from the hobbyist. The professional understands that a single loss or even a streak does not invalidate the edge, only the full block of data does. This discipline also protects your psychology. When you commit to a 30-trade test, you neutralize the sting of individual outcomes. A losing trade isn't personal, it's 1 dot in the dataset. That framing keeps emotions from hijacking your process. You are not wrong, you are running an experiment. And when the experiment ends, you either confirm or refine the hypothesis. To strengthen your feedback loop, journal with tagging specific to your hypothesis. Record whether the market condition matched the hypothesis, whether the signal was clear or forced, whether the entry aligned with rules, and whether the invalidation level was respected. This makes every trade a piece of evidence rather than an emotional roller coaster. Over time, the journal builds proof of your edge, or proof that it needs re-engineering. Both outcomes are wins because they bring clarity. Use visual reinforcement. Next to your screen, keep snapshots of perfect textbook setups. These images remind you what real looks like and protect you from overtrading almost setups. Many traders bleed away edge not by taking bad trades, but by taking close enough trades. The image filter creates a hard line between valid and invalid. When you feel tempted to compromise, compare the live chart to your edge card images. If it doesn't match, stand down. Finally, anchor this process with a daily micro ritual. Before the open, read your edge card aloud. One sentence, one hypothesis. Look at the ideal and non-ideal images for 15 seconds each. This primes your pattern recognition system and calibrates your filter for the day. It also reaffirms that your job is not prediction. It's testing a repeatable hypothesis with discipline. Clarity of edge is the difference between a trader who guesses and a trader who measures. Write your hypothesis like a scientist. Define invalidation before confirmation. Guard against drift by isolating variables and testing over 30 trade blocks. Prioritize forward tests to capture behavior. Externalize your rules on an edge card and reinforce them daily. Do this and you remove the fog. You stop gambling on hunches and start trading like a practitioner who knows exactly what they're testing, why, and how. That shift, from intuition to hypothesis, from improvisation to experiment, is what transforms you from fragile to anti-fragile in the market. Position sizing and expectancy math you'll actually use. If edge gives you a reason to trade, sizing determines whether that edge survives. Position sizing is not an art. It is applied math with a temperament filter. Let the numbers do the heavy lifting so your ego does not. Size small enough to survive variance and large enough to make the edge meaningful. Start with expectancy in plain language. Expectancy equals win percentage multiplied by average win, minus loss percentage multiplied by average loss. If that number is positive, your system has positive expectation over time. If it is negative, no behavior tweak will save you. Expectancy tells you which variables to optimize. Either increase the proportion of good setups, increase average wins, or reduce average losses. It also reveals that obsessing over individual outcomes is pointless. You're not paid for being right on one trade. You are paid for positive expectation across a series. Think in R multiples. Measure risk in terms of R, your per trade risk unit, not dollars. When you size by R, you normalize decisions across accounts and remove emotional attachment to currency. A practical rule of thumb for discretionary trading is to risk between 1/2 R and 1 R per trade, depending on your confidence and the robustness of your edge. Risking 1/2 R on marginal setups, 1 R on textbook setups, keeps sizing consistent. Randomly inflating size after wins or shrinking it after losses turns math into superstition. Fixed fraction sizing is a workhorse. Choose a fixed fraction of your capital expressed in R units and stick to it. For example, if 1 R equals a fixed dollar amount or a fixed percentage of your equity, calculate how many contracts or shares that equals and pre-program it. The point is to convert a gut decision, I feel lucky, into a mechanical one. Discipline in sizing reduces the chance that a single emotional moment ruins months of good decision-making. Introduce Kelly Light as a conceptual guide, not a rule to slavishly follow. Kelly theory identifies the optimal fraction of capital to grow wealth fastest while avoiding ruin, but full Kelly is aggressive and produces large drawdowns. Use a fractional Kelly approach conceptually. Think in terms of growth without ruin. Translate that into practical limits. Never risk so much that a plausible drawdown sequence forces you to abandon your rules. If full Kelly says risk 5 R and that feels destructive, scale it down to 1/2 Kelly or less. The point is to understand trade-off between growth and psychological survivability. Drawdown probabilities are not abstract, they are operational. If you size too large, a sequence of losses that has a low probability but non-zero chance will occur sooner or later. Ask yourself, can I tolerate the worst plausible drawdown without changing behavior? If the answer is no, your sizing is too large. Simulate or model loss sequences to see realistic drawdown paths and make sizing decisions based on survivability, not bravado. Now decide on scale-out rules versus fixed targets. Fixed targets are simple and remove decision points. You set a target equal to a defined multiple of risk and take the money. Scale-out rules, taking partial profits at predefined levels and trailing the rest, can improve realized R multiples in some strategies, but they introduce execution complexity and emotional choices. If your edge relies on momentum that often extends beyond initial targets, consider a structured scale-out. Take 1/3 at 1 R take another 1/3 at 2R, and trail the last third with a predetermined rule. If your strategy is mean reversion, fixed targets often perform better because momentum is limited. Choose the approach that matches your edge and codify it. When to trail versus take profits depends on structure. Trail when the market exhibits extended trending behavior and your edge benefits from letting winners run. Use objective trailing rules, one average true range below recent swing low or a multiple of R that converts to a trailing stop, so you avoid discretionary second guessing. Take profits when the setup historically resolves within a fixed payoff. Whatever you choose, write it, test it in a forward environment, and measure realized expectancy with the chosen approach. Practical controls matter. Pre-fill orders with default stop and target levels before you click buy or sell. This micro-ritual locks size and risk in place before emotion spikes. If your platform supports bracket orders, use them. If it doesn't, place the stop and target immediately after entry. No exceptions. Pre-filling removes the temptation to move stops or to increase size midstream. Pair sizing rules with a daily exposure cap. Even with correct per-trade sizing, cumulative exposure can blow up your account. A daily or intraday cap expressed in R units limits cumulative risk and prevents compounding errors from a series of marginal trades. The cap ties back to the risk ceiling and kill switch we installed earlier. Consistency across rules prevents rule conflicts. Finally, measure. Track win percentage, average win, average loss, and realized R multiples. Calculate expectancy over your chosen sample size and compare it to theoretical expectancy. If real-world execution significantly underperforms theoretical expectancy, inspect slippage, execution timing, and behavioral leaks, not just the strategy logic. Sizing is where math and temperament intersect. Apply the expectancy equation in English: win percentage times average, win minus loss percentage times average loss. Use R multiples to normalize decisions. Favor fixed fraction sizing in the 1/2 R to 1 R range for discretionary setups. Use Kelly-Light conceptually, but scale for psychological survivability. Pick clear scale-out or fixed target rules that match your edge, and pre-fill orders so size is locked before emotion arrives. Do this and you make your edge sustainable. Let the math do the heavy lifting, let your behavior do the rest. Resilience systems, review, recovery, and accountability. Every trader has good days, bad days, and the occasional brutal week. What separates those who last from those who burn out isn't avoiding pain, but having systems that turn setbacks into feedback. Resilience isn't a trait, it's a process. You engineer it with structure. Start with the journal triad. First, capture the numbers, R multiples, win rate, expectancy metrics. These tell you objectively whether your system is performing. Second, write the narrative, what you felt, what you saw, what distracted you. This gives color to the numbers, revealing the mental context around each trade. Third, extract the lessons, what rule held up, what broke, and what you'll adjust. Numbers without narrative are sterile. Narrative without lessons is venting. All three together create a living map of your growth curve. Anchor this with a weekly review cadence. At the end of each week, identify the top 3 improvements you made. Small wins count. Then, choose one rule to tighten and one habit to cut. By narrowing it to just 2 actionable changes, you keep the loop focused. For example, you might note, improved patience on entries, need to tighten pre-trade checklist, habit to cut, checking social media during sessions. Over time, this cadence compounds into a cleaner process because you are consistently refining the system rather than reinventing it. Recovery protocols protect your edge when drawdowns hit. A brutal week is not the time to double down in frustration. It's the time to reset. Prioritize sleep. Aim for consistent hours to restore cognitive sharpness. Move your body daily. Walks, strength work, stretching. Get direct sunlight early in the day to reset circadian rhythm and mood. And most importantly, honor no-trade days after large drawdowns. A pause is not weakness, it is active capital preservation. Recovery protocols shift your nervous system out of fight or flight so you can return to the market clear, not desperate. Accountability magnifies resilience. Alone, it's easy to rationalize breaking rules. With an accountability partner, or even a public scorecard, you make rule adherence visible. The goal isn't shame, it's structure. Share your weekly review highlights and rule commitments with a trusted peer or mentor, or publish a simplified scorecard that tracks process metrics, not P&L. Did you follow the playbook? Did you respect stops? Did you size consistently? Knowing someone else will see the report keeps you honest. The final piece is a micro-ritual, the Friday Rule Refinement Meeting. 10 minutes, non-negotiable. At the end of the week, sit down and review your journal triad. Decide which single rule you will refine, update, or reinforce. This practice keeps your trading system alive and adaptive without turning into strategy drift. It transforms setbacks into structured adjustments and closes the loop between action and learning. Resilience is not built in crisis, it is built in cadence. With the journal triad, weekly review, recovery protocols, accountability structures, and a simple Friday refinement ritual, you create a system that absorbs volatility in both markets and emotions. A bad day becomes a lesson, a bad week becomes a chapter of growth, and a career survives long enough for the edge to pay. You've just installed the 7 upgrades that separate a disciplined operator from a drifting gambler. No fluff, just rules that compound. Think of this as your trader's firewall, boundaries that lock in discipline, habits that protect your edge, and systems that keep you steady when the market turns chaotic. From risk ceilings to anti-tilt resets, from process playbooks to resilience reviews, this is the operating system that turns intent into execution. The market will always be uncertain, but you'll be anchored. And before you log off, make your first commitment trade right here. Type the word committed in the comments. That's your signature. That's your contract. Because by tomorrow, you won't just be hoping you can stick to the plan. You'll already have declared it. Take a breath. Close the noise. The next chapter isn't about luck. It's about discipline on repeat.
If you found this helpful, hit like, subscribe, and tap the bell so you never miss a drop. Got thoughts or questions? Leave a comment below. I'm always checking in. Thanks for watching, and I'll see you in the next one. Check out this next video.